Hello everyone, this is Andrew with Spark Finance. And have you heard about all this talk about inflation? And people are discussing how this is affecting businesses and the economy and investing. That's kind of what I wanted to go into the topic for today. Keep in mind, inflation is a rise in general price levels over a period of time in the economy. And if you want to get some more information on that, check out my other video just on defining inflation. Now, if you look around and realize that everything you buy is going up in price, whether you're going down to the store to buy some groceries, or you're buying your college courses, or your steak dinner that you get at a restaurant, all those prices are increasing from last year to this year. That's inflation right there. They all slightly increased in price. And inflation measures that increase. So with the data just released from March and April of 2021, for the Consumer Price Index, remember that's the official statistic that we use to measure inflation, it showed that there was a 4.2% increase year over year in inflation. That is the largest 12-month increase going back all the way to September of 2008. So you can see why this inflation talk is making headlines right now. Keep in mind, at the same time as all this is occurring, the Federal Reserve was pointing towards the inflation rate. Their target was for 2%. And just in the first few months of the year here, we are already on track to be over double the official Federal Reserve target for the inflation rate. And that has got a lot of people talking and getting ready for more inflation on the horizon. We're coming out of a pandemic here, so this is a very unique situation in the economy, and we're seeing a lot of inflation brewing up here. If you look at the price of really almost any commodity, it has been going up significantly in the past year or two. Seeing only a single-digit inflation rate in one of these commodities, which is normally the standard, would be a rarity right now. This is not a normal economy. We're seeing double-digit growth in the prices of these commodities. Now, when you have 15 or more commodities going up double digits, you have housing prices rising 10% in a single year. The prices of collectibles and cryptocurrencies also greatly increasing in a short period of time. Gas prices even hitting a 7-year high. That's inflation. It's throughout the whole economy. It's not just one or two areas that are seeing record-setting prices. It's kind of going on everywhere right here. The price of lumber went up so much, it's adding like $20,000 or more to the price of building a new home. Last year, I spoke about the collectible cards, the craze around that, and how Pokemon cards and sports cards and collectibles and basketball cards, baseball cards, they were all going up in price. Well, records were just set for all of those. We just had a Babe Ruth pre-rookie card that sold for a record $6 million, now the most valuable collectible card ever sold. Then you have a non-fungible digital token on the blockchain. That sold for $69 million. So you're seeing these crazy records here, and you're seeing prices increase on a lot of different assets. It gets people a little scared that inflation, it's here to stay, and that asset bubbles are forming in certain areas. After all, when you see prices doubling or tripling within a few months of a year, that's pretty incredible. It's definitely an outlier. If you're looking at like a chart or just a long-term trend for what happens, you don't see these kinds of jumps. Now you even have famous investors like Warren Buffett, who spoke at his annual shareholders meeting about he sees inflation and they're passing it on to consumers, and the consumers are just paying it, so they're just going to keep passing it on. That means it's spreading throughout the economy. Then you had Bill Ackman, another famous investor, speaking about inflation and how he's changing his portfolio around it. And then you had Ray Dalio, the owner of the largest hedge fund. He started that fund. Now he's talking about how inflation could be a threat and not to invest in bonds right now. Actually, I believe Warren Buffett said that as well. Like, everybody's staying away from bonds. They're saying that's a cautious area to be in. They're saying cash is trash and inflation is here and you have to adjust to that. So if the majority of money managers around the world, or a lot of the kind of most successful business or investors that are out there, are talking about this, maybe the average person should be thinking about it as well, right? Now, the concern here is, why can inflation be bad, right? Why does it even matter? Over time, inflation destroys the value, including the very money that you have in your wallet or in your bank account, it destroys the purchasing power of money. So let's say you have a set amount of money under your mattress in your room. Every year, that money, if you go out and buy goods, it can buy a certain amount of goods. But if you wait, say 5 years, and you try and go and buy, 100 apples with the money that you saved under the mattress, you can no longer buy 100 apples. You can only buy 75 apples, or you could only buy 50 apples. Every year, your purchasing power is being lost due to inflation and the value of the currency going down. Now, inflation acts like a hidden tax that you have to pay on all the money you have already earned and saved up. And rich people try and get around this by putting their money into assets that give them income back or some type of yield back so they can earn money on their money. Now, remember when vending machines, they used to charge you 50 cents for a drink. Now I try to go and I get a bottle or something from the vending machine, it costs $1 or $1.50. This is like the old saying when Grab Happy used to come in and go, I used to buy that Snickers bar for a nickel. Well, the prices have gone up over time. And the point is that money that you have saved can now buy less goods if you go out today versus when you saved it a year ago. It buys less goods in the marketplace. It has lost value through inflation. So let's say inflation gets crazy high and runs over 10% annually. That means that in just 7 years, a car that cost you, say, $20,000 before, now would cost you around $40,000. It would double. A house that was $300,000 and then having inflation run at 10% means that in 7 years, that house would cost around $600,000. The key thing here is that if your salary and your income is not increasing as fast as the inflation rate, if you're not able to keep pace with the inflation rate, you're able to buy less and less goods in the marketplace. Your purchasing power is getting smaller and smaller to the point where if you're on Social Security or something like that, you can barely get anything anymore. You might have to take on a job to be able to afford things. And when you see money going into all these different areas, they go into speculative assets, people are wondering if inflation is causing bubbles to start forming here. And that could be dangerous because when a bubble pops, it could lead to a recession. Remember that. So who gets hurt in these situations? People working for low-wage jobs or labor that is easily interchangeable, they get really hurt here. With no additional skills around their profession, the wages for those types of positions are going to be the last things that would increase with inflation in the economy. So if you don't have special expertise in a certain field, or it has new barriers to new entrants, then that could be a problem. People complain about how it is getting harder for the everyday person to make a living while the rich are able to continue to increase their wealth, right? Well, creating massive inflation in the economy greatly helps with the income disparity between rich and poor. Just look at how the CEO pay over the last few years has been jumping up like crazy while the average wage growth is not so much. Now, if you own real assets or investments and you're wealthy, they will go up in price along with inflation. You can position yourself pretty well that you can do better when there is a time of inflation because your assets will go up in price. If you have a single job that you are earning a salary from, you pay all your bills with that salary, and that's all you can do, you can't really take advantage of inflation. And that's why those that are rich will be able to capitalize by owning all the assets that will go up in value along with inflation. So even people along down the spectrum should be trying to get into assets that can preserve their wealth so that it is not taken away through the loss of purchasing power. So people that are retired or live on a fixed income, they are getting hurt really bad by inflation too, right? If you're on Social Security and you're getting a certain amount every month, or you have bonds and you're getting a certain amount every month, even though there's also people that did that FIRE, the financial independence, retire early, and they have a set amount that they can use every year. Suddenly, their budget is not covering all their expenses anymore. The income they receive from their investments or Social Security will be able to purchase less groceries, less housing, less entertainment than it could before. And it's hard to get out of that. Another thing that's hurt here are high growth companies and investing. So stocks of high growth companies, when interest rates rise along with inflation, You are not willing to pay as much for the future earnings of a company when you can get a high return right now on interest rates, and the value of those future earnings are worth less because of inflation. So technically, growth companies have a little bit of a struggle period during inflationary times. So what exactly would benefit in times of inflation, right? A lot of this goes into hard assets. That means anything that is kind of tangible that you can hold in your hand, or real things, not paper investments or stuff that's crazy like that. You can hold a bar of gold, or you can have a plot of land that you can go and you can walk on and you can experience. You can go into a building that's around you. Those are all hard assets that can go up with the rising inflation. Commodities usually do very well in times of inflation, as we are seeing right now with all of those commodities up so much. And there's particular companies that benefit when the commodity prices go up. They are basic input materials that will rise along with the price of inflation because they go into everything in the economy. Now, people, of course, that hold the assets or investments, they will also see assets increase in value with inflation if they're in the right ones. Like real estate is another thing here. If you're in real estate and you get a mortgage now, all that money that you pay back over all of those years will be in depreciated dollars. They will be worth less because of inflation. So if inflation is 5% and you have a mortgage at a 3% rate, you get an extra 2% in purchasing power on all that money that you're spending to pay them back over all that time period right there. So it helps people that are actually in debt when there is high inflation. A lot of other people own stock in a business that have pricing power where they can pass on the cost increases to the consumers, and they're not so much getting hurt on the profit margin side. So a company that's a cyclical company, like maybe company like Coca-Cola, they can usually pass on their costs to consumers without having consumers cut back too far. Some people in in-demand sectors of the economy, they will have their wages greatly increase with inflation. But that's the issue again, you have to be in the right sectors where they are in demand, and a lot of the inflation is going into that area. The prices for whatever you buy though, if you're in a normal job, remember, those prices are going up on a weekly, a monthly basis, but you're only getting a wage increase potentially at the end of the year. So that whole year, you're paying higher prices for everything. Oh, and then at the end of the year, you might get a wage increase. So the big discussion right now is this whole inflation trend, is this transitory or not? And this was brought up by the Federal Reserve Chairman, Jerome Powell, who keeps using this term transitory. And that means that it's just for a temporary period you're going to have inflation and it goes back to normal. Now, I remember when Ben Bernanke, he gave a speech on TV in front of Congress a few times, but he gave a speech where he was talking about the subprime mortgage crisis, and he said, no, the subprime crisis is actually contained. And he said this right before the 2008 financial crisis. So these guys that are in charge of the Federal Reserve, or women that are in charge of the Federal Reserve, they're not oracles. They can't predict the future. So they may say things that they have to be a cheerleader for the economy. They can't always say exactly what is going on. Now, during this pandemic, the M2 money supply, which is basically a measure of how much cash is out in the economy and sloshing around, it went up from $15.5 trillion to $19.6 trillion through this pandemic that we just had. Now, where do you think all of that money is going to go, right? If there's all of that sloshing around, it's going to go into different assets. It's going to go into different places. Now, when was the last time there was no inflation for a whole year? When was it just transitory? There was a little bit of inflation, it went away, or we had, prices actually go down, right? Well, if you look at the consumer price index, the only time in recent memory that occurred was around the 2008 financial crisis. That was the only time the CPI was negative for the past, 50 years? So when the money people earn is becoming worth less and less every year, no wonder why so many people are going into stuff like cryptocurrencies and are trying to kind of get out of this or find a way out. Now, in the 1920s, there was an expansionist monetary policy and a growing economy, right? That's why they call it the Roaring Twenties. That went on for a long time, a decade. But then at the end of the decade, 1929 into the 1930s, that didn't end so well, right? That ended up into a depression. So now we have to see what happens with all of the stimulus and money that we put into the system now. Is it going to result in something different? If the current, I guess the solution that people are looking towards here, the current economy, we have a way to solve the problem of inflation right now, right? That's for the Federal Reserve to come in and massively raise interest rates. And the interest rates that they raise affect everything from your mortgage to your car loan to how much money you get when you put money in the bank. Now, last time they tried raising rates, that was back in 2019, right before the pandemic even started. It got up to like 3.25% or something like that. And it crashed the overnight lending market for banks, and they had to stop raising rates. And that wasn't even in like a recession or a bad period. In the 1970s, we had stagflation. There was massive inflation, even though there was barely any economic growth. The economy was stagnant, but inflation kept going up, helped by an increase in the money supply from the Vietnam War and Federal Reserve, and also additional spending on government programs. Now, this lasted for years until the Federal Reserve chairman at the time in 1981, Paul Volcker, came in, and he said, I'm going to stomp out this inflation. And he took the interest rates and raised them to 20% to draw money out of the economy and stamp out inflation. It took money away from spending on goods and services and put it into bank reserves and forced it out of the economy. Now, imagine paying 18% for your mortgage for your house in this kind of environment. It's pretty crazy. And the problem with that is that it causes recessions. Usually when the Federal Reserve is done raising interest rates, it causes a recession and then they have to start cutting rates again. In 1982, the unemployment rate went up to 9.7%. And for 20 years, the stock market had like measly returns, didn't do anything. But this was a way to stop inflation. So remember, rates went up from 2004 to 2007 to 5.25%. And then when it hit that over 5%, it triggered the subprime crisis and we had everything fall apart in 2008. So that's really the worry about all this, is that if the Federal Reserve is not actually able to manage this well, this is going to be a major problem. If it doesn't peter out or the Federal Reserve doesn't stop it, it can cause some major ramifications for the economy and a recession. There will always be a problem with fiat currencies that are not backed by anything and that can be created kind of ad nauseum by the will of the people in charge. The history of paper money or fiat currencies doesn't look too bright either. I would encourage you to check out some information on the Mississippi bubble if you want to see how fiat currencies have fared in the past. Now, the big test for the future, we'll be seeing if inflation caused by goods shortages around this pandemic, which was a very unique situation, and the reopening and potentially booming economy with everybody finally able to go outside, go to stores, travel to different locations. If that's going to create a boom, that's a lot of demand. And then you have on top of that money printing in excess of any period that we've done in history before, of how much money that we've put into the system. Can that all naturally balance itself out, or will the government or the Federal Reserve have to come in, raise interest rates, raise taxes to pull money out of the system to kind of save it from massive inflation and at the same time not cause a recession? So this is going to be fun and scary to watch exactly how this is going to go. But one thing is pretty certain from all the news that I've been hearing right now. There are very few financial people or news articles right now talking about there being hardly any inflation or no inflation. And your everyday person can even see the inflation when they're going to the gas pump or the grocery store or their department store. So we do see that this is occurring. We see it now officially in the numbers that they come out after they actually happen. So they're a little bit delayed there, but we're seeing it in the numbers now. Is this going to be transitory, or is the inflation here to stay for a long period of time? We'll have to sit back and watch and prepare accordingly. Thanks for watching Spark Finance. If you want to check out some of my other videos, I even have a video on inflation that you could check out that explains a little bit more detail on what's going on with inflation. And then I have other videos on business, investing, and economics. Once again, this is Andrew. Enjoy.